Hello and welcome to today's video. In this video, we are going to take a look at the Finviz stock screener settings for identifying stocks with strong balance sheets. And these will basically result in a list of stocks which are recession proof. Because whenever we talk about recession or whenever we talk about an economic slowdown, the first thing is that a lot of companies can go into bankruptcies, and we want to filter out stocks which have weak balance sheets, which can result in such a situation. So the investors or traders can lose a lot of money with these kind of companies. This is what we are going to cover here. We'll take a look at the concepts quickly. What basically makes a company's balance sheet strong and what makes it weak, and then we'll go to the Finviz stock screener and look at the actual settings, and we'll see what companies come up in today's output. So let's get started. Before we proceed, a quick look at the disclaimer, which states that any information that I'm sharing with you is only for entertainment purposes. It is not any kind of trading or investment advice. If you intend to make any trades or invest your money, please get in touch with a certified financial advisor. Before we get started, I just wanted to call out that a lot of trades that I'm taking, I'm putting on the community tab of my channel. So you can go to my YouTube channel, Serene Trading Strategy, and there, if you navigate to the community tab under there, you will see that I'm posting the trades that I'm taking here. And usually, when I take a trade within the next few minutes, I post the trade here as a post, and it has complete details on what was the trade that was taken. Usually these are related to my options trades. So what options I sold or bought, and how was the trade taken, and whether it was profitable or not, what is the return, and then the running profit of all the trades taken together that I have taken till date. These are available. So this information right now, my trades are available for free on the community tab. All you have to do is subscribe to the channel and enable the notifications, so that as soon as I take a trade and I make a post here, you get notified, and then you can follow those trades. And usually this kind of trades nobody gives out, and people who give out will actually charge a subscription for this. For now, I'm giving these out for free, and these are actually profitable trades. You can check these out. And when I take the trades, I'm posting them and I'm closing, and these are not day trades. Okay, so I'm closing them after 2 days, 5 days, 10 days, 20 days, depending on how many days the trade was open. And I don't know whether the trade is going to be profitable or not, so I'm not picking the profitable trades and then posting them here with the benefit of hindsight. I am posting them as soon as I take them, and then whatever way it turns out, the information is available right in front of you, and you can yourself judge how my performance is. And if you want, you can follow these trades, because that forms a very important part of the learning experience. And even if you want, you can paper trade with these trades. You can follow them and use this information in any way that you actually want. Just wanted to call out that this is, you can go out and search, you can Google this information, and this is actually paid stuff. People will charge you money for sharing their actual trades. I'm doing it for free for now on the community tab. All you have to do is subscribe to the channel and enable the notifications, so that as soon as I post it here, you get notified. So let's proceed now. The first parameter that I want to call out is the debt to equity ratio. And if you want to identify stocks which have a strong balance sheet, the debt to equity ratio for those stocks should be low. Now, why is that important? This is important for two reasons. Number one, in this environment, what is actually happening is earnings are going down. So companies which have taken up a lot of debt, they need to service that debt. That means they need to pay the interest payments on a yearly basis or whatever the schedule is. And usually companies feel that they will have enough earnings. So from their earnings, they will be able to pay out the installments. But now what are we seeing? With the market slowing down, with kind of a, some people calling that a recession might happen, the earnings basically have come down. And when earnings come down, these companies are not generating enough cash flow, enough money to be able to service those debts. So companies which have a lot of debt, their debt installments are not going to come down. They are going to stay the same, or in fact, as I'll discuss in the next point, they may increase as well. But the cash flow, the earnings on which servicing of this debt was dependent, is now gone, or it's reducing. So first of all, we do not want to be investing in companies which have a high debt to equity ratio, because those companies will have this huge problem. Earnings is going down for everybody. When earnings go down, but you still have to make the huge installment payments, from where will these companies get the money? They may either issue more debt, that means they will take more debt, or they may issue more shares, or they will eventually have to file for a bankruptcy. So debt to equity ratio is something which you need to watch out for. Look out for companies which are debt free, or even if they have debt, the debt should be really low. The exact setting, how much it should be, I'll discuss later when we go to the Finviz stock screener. So you will get to know how much the debt to equity ratio should be, but it should be low. The second thing Okay, before we proceed here, I mentioned two things are there with regards to debt. Another thing that happens is that now the interest rates are going up. In order to curb inflation, Fed is increasing the interest rates, and when the interest rates go up, a lot of debt, corporate debt that the companies take up, this has a base rate and then there is a variable rate. The base rate is actually the one which Fed is increasing because the base rates are now going up. So the overall interest rates are going up. And so the debt is becoming more and more expensive. So think about the situation companies which have a high debt to equity ratio, that their earnings are anyways coming down with the given environment. But at the same time, the debt payments may start going up. For those companies which have variable rate loans, which is usually the case, the debt payments will start going up. So this is a double-edged sword, and it's very important for you to stay away from companies which have a high debt to equity ratio. Now let's go to the another point, which is shareholder dilution. Now shareholder dilution means the outstanding shares of a company, they keep on increasing. Why? Because the company keeps on issuing more and more shares. Now this is a trick that a lot of company managements basically use because there are only two ways that a company can raise money. One, they can take on debt, so they can borrow money. The other thing is they can issue shares, that means equity, and again they kind of borrowing money but from investors instead of an institution like a bank or another financial institution. The problem is that a company is, if a company issues more and more shares, that is indicative of the fact that it is not able to generate enough cash internally to meet to run its operations, to basically be comfortable. Okay, so let's say you invested $100 in a certain company and you bought certain number of shares. Now, if the company issues another set of shares and you are diluted, you own a lesser percentage of the company. So you, let's say you bought 100 shares and the total number of shares in the company was, outstanding shares was a billion shares. Now a company has issued 1 billion more shares, total number of shares have become double. So your percentage ownership, 100 shares as a percentage of the new total 2 billion shares, is now half of what it was earlier, right? So this is called shareholder dilution. So the debt is going to hurt you, the shareholder dilution is also going to hurt you. It's one and the same thing, but it hurts you in different ways. And the problem with shareholder dilution is that a lot of people don't pay attention to it because it doesn't pop up in any of the filters. Even when we look at the Finviz filter, debt to equity is a filter there, so companies which have a high debt to equity ratio will get filtered out, but shareholder dilution is something which gets missed out. So managements may use this tactic to basically again raise more and more money, which is indicative of the fact that their operational income is not enough to sustain their operations, right? So shareholder dilution is something you should look at. Number of outstanding shares should not be increasing. If the company is not buying back shares, fine. They should not at least be increasing the outstanding shares. Third thing is price to book ratio. Now, if you don't understand the concept of book value, first of all, you need to understand that. So I'll briefly discuss it here. I'm not going to go into a lot of detail. You have assets on a company's balance sheet and then you have liabilities. If you subtract the liabilities from the assets, the remaining portion is called equity, which is also called the book value. Okay, so book value is nothing but the net equity in the company. So when you buy shares of a company, assets is something you own a portion of the assets, right? Then you own a portion of the liabilities also. But if you subtract these two, then you come to the net equity or the book value, which is your net ownership. Now we want to invest in companies which have a low price to book ratio. Why? Because let's say I am investing in a company which has a price to book ratio of 1. That means for every $100 that I invest in the company, the net assets means assets minus the liabilities, the net equity, I should say, that I'm gaining is also worth $100. So I'm actually getting something concrete in return which has a worth of $100 in the market. Compare that to a company which has a price to book ratio of 50. So for every $100 that I invest, I am getting only $2 worth of net equity. The rest of the valuation of the company is just based on its future earnings, and those earnings may or may not happen given the current environment, right? So we want to invest in companies which have more valuation in the current assets that they hold rather than the valuation coming from their future earnings, which may or may not happen, right? So we want to look at the price to book value of the company very closely, and we don't want to invest in companies which have very high price to book ratio. The exact value we'll see in the later part of the video when we go to the actual stock screener, the Finviz stock screener. This is again very important because it's related to the book value. I told you, you take all the assets, you subtract all the liabilities, you get the book value, correct? Now, what if a major portion of these assets was intangible assets like goodwill or brand value? Okay, brand value or goodwill is something which you cannot trade in the market. Okay, if another company tries to acquire you, fine, you can add this as part of the sales price. But if you want to make a repayment for a loan, you cannot basically service that repayment with goodwill. You need actual cash. So that is why we want to look at tangible assets. We don't want to look at intangible assets in these times, because intangible assets will lose value very, very fast, or they may have actually zero value. Because let's say Bank of America has given a loan to a company and they don't have cash to pay off that loan, but they have a lot of goodwill on their assets, on their balance sheet. Do you think Bank of America is going to accept the goodwill as a payment? No. Bank of America is going to ask for hard cash. They will want assets which they can liquidate and generate cash and use it to service the debt. So in these times, if a lot of assets, if a major significant portion of the book value, that means what we discussed earlier, you take all the assets and subtract the liabilities. The liabilities, you can't pay off them with things like goodwill or intangible assets. So you don't want to see a lot of book value coming from intangible assets. So whenever you're evaluating a company's book value, don't go with the book value that is mentioned as a calculation, because that will include intangible assets. Remove the intangible assets and then see what is the revised book value. It shouldn't change by much. If it's changing by much, if the book value drops significantly as soon as you remove the intangible assets, stay away from those companies. Dividend payout ratio. Now this is very, very important, because this is something which the managements of a company fail to maintain at the right amount. So ideally, when a company is doing well, when the overall macroeconomic environment is good, the dividend payout can be a bit on the higher side, because you have growth, right? You have a lot of possible growth, and you basically chances of you running into trouble is low. So ideally, that time dividends should be paid out. But when the environment is not good, dividends should stop, in my opinion, because first thing is the business has to survive. The company has to survive the tough times. It is not important whether you pay out dividends to the shareholders right now, because shareholders are nothing but investors, right? For investors, it doesn't make sense that they receive a 2 or a 3%, 4% dividend payout consistently for the next 3 years, but 3 years later, the company files for bankruptcy and they lose all of their principal investment. That is something which is not any investor wants. So ideally, when times are tough, managements of the company should retain all the money with themselves, stop paying out the dividends. So you don't pay out that 2-3% a year for maybe 2 years, but then you utilize that money to sustain the operations of the company in the tough times, and so that the company survives. But most managements will not do this. Why? Because they are part of unique clubs. Their companies are part of unique clubs called dividend kings or dividend aristocrats, which are basically definitions to say that this company has paid out dividends for the last 25 or 50 years, and they have been paying out increasing dividends. So they don't want to get off that uh, charter, that list, because that's kind of a prize or an award for them that we made it to the list where we have paid consistent dividends for 50 years. More important thing is, you pay out dividends or you don't pay out dividends, it's the health of the company that matters. So the company should be in a healthy state. You need to have extra cash with you. You need to retain that money with you when the times are tough. When the times are good, you pay it out to the investors as dividends. That is fine. But most managements will not do that. So right now, what you need to do is, you need to look at the latest payout ratio, which is basically the ratio of uh, the percentage of the net income that is being paid out in dividends. If that ratio is anything less than 30, less than 40, fine, the company is doing fine. Because let's say dividend payout ratio is 30% for a company, then for every $100 it makes, it's only paying out $30 to the investors in dividends. $70 are still being retained within the company, which can be used to take care of the tough times, to meet its debt obligations, or to basically support the operations of the company, or to absorb the increasing supply chain costs for the company. Any kind of an emergency that the company has to handle, they have funds, because all the funds that are coming in via the net income, they're not being paid out as dividends. But if you see the dividend payout going high to about 90%, 80%, 70%, even 60%, stay away from those companies. Because when these companies will need money, the easiest source of money and the cheapest source of money is their net income. But if they're paying out a huge portion of that net income in the form of dividends, when they need money, they will either dilute the shareholders by issuing more shares, which we discussed earlier, or they'll raise more debt. That means they'll get into a cycle where their debt obligations will keep on increasing, and with increasing interest rates, it even becomes more difficult to service that debt. So payout ratio is very, very important at this time, because a lot of companies, in my opinion, will fail to reduce their dividends or stop their dividends because they want to be part of those exclusive clubs, dividend kings, dividend aristocrats, which for investors is not should not be important at all. There's no point being part of a club and then declaring bankruptcy or getting into financial trouble. So most company managements will not do that, and by the time they do that, usually is very, very late. So the safest thing to do is to make sure that you don't invest in companies or trade in companies which have a high dividend payout ratio. It should be less. Then one more thing is price to earning ratio. Now price to earning ratio, some of you may say, is not a balance sheet figure, it's coming from the income statement, right? But this is important, I have to discuss it here, because this ratio is something which can make a strong balance sheet and convert it into a weak balance sheet. So how does that happen? Let's say you identify a company using the previous criteria which has a very strong balance sheet. Okay, so it's got little debt, it's not paying out a lot of money in the form of dividends, it's basically a strong balance sheet, and there's very little chance of the company going under. But just one parameter changes, that in today's environment, when earnings are going down, this company starts losing money. That means the PE to E becomes negative, earnings become negative, it starts losing money. When they start losing money, when they start burning cash, then a strong balance sheet is eventually going to become a weak balance sheet. Why? Because when you burn cash, you cannot fund your operations, you cannot meet your operating expenses, and you will have to raise cash either by debt or by diluting shareholders. Over a period of time, if that sustains, if this process sustains, the company will eventually deteriorate and it will eventually file for bankruptcy. So in the current environment, earnings are going down for almost every company, and that is fine. But stick to companies which, even with reduction of earnings, have a positive earnings. That means they are not burning money. They are making less money, but they're still making money. They're not losing money. Because any companies which cross that line from making less money to losing money will eventually burn all of their cash, will burn all of their assets, and they will start piling on debt. They will start that cycle which is destructive to a company. And right now, there is a lot of speculation. Some people are suggesting, some experts are suggesting that this is only a correction, and in the next few months, we'll see the market again going up, and the supply chain pressures and everything will get sorted out. Some people say this is a long-term recession; it's going to stay for next 2 3 years. Inflation is not going anywhere, so this trend is going to continue. The prudent thing for us investors to do is to be on the safe side. So do not invest in companies which are basically getting into the negative earnings territory. Earnings may come down, that is fine, because of the overall environment. Almost every company is facing that problem, but don't invest in companies which have a negative earnings. So before we go to the Finviz platform, again, I just want to quickly call out, I showed you the community tab and where I'm posting my trades for free right now. You can follow those trades. Just subscribe to the channel, enable the notifications so that as soon as I post a trade, you can get notified. Most of the trades, in fact, all of the trades are swing trades. So there are no day trades there. And so it's not important even when you receive the notification. If you don't see the trade for a day or two, doesn't matter, because the trade may still be viable, it may still be active, and you can watch that trade even a day 2 days later, because a lot of trades I keep them open for 5 7 10 20 days, and at the time 2 days later also you can get into kind of a similar position that I got into. So you can check out my trades and see how I basically execute those trades and how they turn out. So now quickly let's get into the Finviz stock screener, which look at the exact settings, and then from there we'll see what companies come out in today's screener output. So here is the Finviz stock screener platform, and for those of you who are new to this platform, I'll leave a link in the description. They have a free version and a paid version. You can try out both of them, and I will leave a link. So I have a complete series or a tutorial around how to use Finviz, and I have a lot of other screener settings that I have shared. This particular screener is only for identifying stocks with a strong balance sheet. Okay, so you need to club it probably with other criteria to form a complete trading strategy. But this one, we are going to see how do you identify companies which have a strong balance sheet. So I have already done some of the settings here. First thing we discussed, price to book value. So price to book, as I said, we want to acquire a major portion of the equity in the company when we invest into a company. So I want to look at companies which have a price to book value less than 5. Now what that means is, for every $100 that I will invest into the company, I'm at least buying $20 of equity or net assets in the company. Rest of the $80 valuation is based on the future earnings of the company, but $20 I am already receiving today itself in terms of the net assets of the companies. When I say net assets, I mean you take the assets, subtract all the liabilities. So I am getting some portion of ownership today itself. If you look at some of my trades, they are on Citibank. Citibank, when I got in, it was trading at a price to book ratio of 0.5. That means for every $100 that I was investing into the company, I was getting assets, net assets of the company worth $200. So you can see that's a very, very safe investment. Even if Citibank's earnings, as long as they don't go negative, they don't start burning cash, even if their earnings come down significantly, I am still not at a loss because I'm basically buying, it's kind of saying I'm buying a safe for $100. But if I open the safe, inside that safe there is a $200 bill which is inside there. So price to book value is something like that, that when you buy a company, how much of the actual assets you are buying, net assets you are buying along with that company. So price to book, we'll keep it under 5 so that we do not have a dependency to recover our money on the future earnings of the company. Some portion of the value you are buying right now in terms of the assets that you're acquiring when you invest into the company. So next thing is price to earnings, and I already mentioned this. Price to earnings should be positive. Positive means the earnings are positive. So earnings will come down, and it has come down for most of the companies in the last couple of quarters because of the recessionary trend we are seeing and the slowdown we are seeing. Inflation also is a major reason for that. The war is also a major reason for that. So multiple reasons in the macroeconomic environment. But again, we are okay with earnings getting slowing down, coming down, but we do not want to get into the negative earnings territory. Reason and concept I already explained previously. So this is another setting. Then another one I've done is debt to equity. Debt to equity was the first thing we discussed, and concept is very clear. You do not want to get into companies, so we are putting debt to equity less than 0.2. 0.2 means that this level of debt is easily serviceable based on the assets of the company. So in the worst possible scenario, what you will have to do is company will have to liquidate some of its assets, and it will be easily able to meet these debt obligations. But the chances of the company totally going under or bankrupt will not happen. And usually when companies have a strong balance sheet, when debt to equity ratio is less than 0.2, even if they don't have cash to pay a debt, the debt will get restructured. That means they will be given more time, maybe another 2 3 5 years to pay off the debt, because everybody is watching the company balance sheet and they know that the company doesn't have too much of debt. Only thing is right now they're not in a position to pay, but it's that small an amount that in the worst scenario they will sell off their assets and pay it today itself also. So why force them to liquidate their assets? Let's restructure the debt, give them more time, so in due course of time when the market, the macroeconomic condition improves, they'll be making enough money to service the debt. Now the price to free cash flow, I have put it at under 5. The reason here is that the earnings of the companies are coming down, so the net cash flow that a company has, we want to make sure that we recover our money in at least 5 years. So let's say you're putting $100 into a company. Net cash flow basically means that by its operations or by investments or whatever ways the company makes money, you will be able to recover your money $100. The company will earn that in free cash flow within the next 5 years. So at least 20% of your original investment the company is able to generate today. So this is again a safety factor, that earnings may or may not continue, they may slow down, but the company has net free cash flow. We don't want to be really investing in companies which have no free cash flow or very little free cash flow, because again, if a company has very little free cash flow, there will be nothing left to service any debt or to meet any emergencies. So this is another setting that I have put here. And the country filter I have put to USA. Now you can put this filter, or you can basically remove it. I want to restrict to investments right now only in the US companies. The reason is because US standards are kind of the best when it comes to auditing and the quality of the balance sheet, and basically I trust the data on the balance sheet and the income statements of the US companies more, as opposed to the companies of other countries. So right now you can use this filter, or you can remove this filter. If you want to invest in international companies as well, you can actually remove this filter. So this is the criteria which you have to use in order to identify companies with a strong balance sheet. But this does not form a trading strategy in itself, so you have to club a few other things. For example, let's say with this base criteria, now we have filtered down to 52 companies, you can see here. So there are 52 companies which satisfy this criteria that this is a strong balance sheet. So 52 companies have a strong balance sheet based on this filter. Now let's say I want to further filter down to companies which have good growth potential. So for that, what I can do is I can select only companies with PEG ratio less than 1. So now let's see what results come up. So it's just loading. Let's give it a minute. Yeah, so now we are down to 19 companies. So we had 52 companies which had strong balance sheets, but out of those 52 companies, which companies are showing a good growth prospect? That is these 19 companies. So now we are down to 19 companies from the 52 companies. You can use different criteria, and you can basically select companies which meet your trading or investment criteria. Now, for example, you're not looking at growth companies, so let me remove the PEG criteria. I'll remove this, but you're looking at companies which are kind of not overbought, means there has been some selling in the recent times. So let's select not overbought. Okay, so I want RSI to be less than 50. RSI less than 50 means that in the recent times there has been some kind of selling or at least not buying pressure on those companies. So out of 52, now 45 companies have this. So let's make it even more strict. The RSI filter, let's put it to actually oversold. Companies which have been just oversold. So let's see how many companies come up. And now you can see 7 companies are there. So now we are using the strong balance sheet criteria and clubbing it with a technical criteria that the RSI is oversold. So based on whatever strategy you want to create, you can club the balance sheet filter, the stock screener settings with other settings, and you can see a lot of Finviz screeners in my other videos. I'll leave a link in the description, you can watch them out. But the basic idea of this video was to understand how do we identify companies with a strong balance sheet. Now if you are trading in the short term, you can use it along with RSI. If you are trading in the long term, you're looking to invest in growth companies, you can use it with the PEG ratio or whatever criteria you want to create, whatever kind of filter you want to create, you can do that. But at this time, my recommendation is that uh, be careful with your money, what you're investing, because the markets are very, very volatile. They get into a bearish territory very easily, and there is a lot of speculation that we may enter into a recession or we may see a lot of slowdown. So it's prudent to stick with companies which have strong balance sheets and which will survive, which have a higher chance or higher probability of surviving these tough times. So I have given you all the details of the screener. So in this particular video, I have shared with you all the details of the screener that you can use to identify companies with a strong balance sheet, and I also shared the technique that how you can club that filter with other criteria. So if you have any comments or if you have any suggestions, if you have any questions, please leave them down in the comment section. I'll definitely respond to you. Also, please subscribe to the channel, like the video if you like the content, and share this with your family and friends. And I'll catch you guys in the next video. Thank you for your time.